Ever wondered what a $117 million investment looks like in the heart of Texas? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Recently, a groundbreaking ceremony was held for the Miyako Hybrid Hotel Plano, marking a significant development in the area. This $117.5 million hotel, which broke ground just days ago, is set to rise 12 stories high and will feature 217 rooms. It's all set to open in the fall of 2027. This will be the first Miyako Hotels and Resorts property in Texas and only the third in the United States. Located within the park at Legacy Development in Plano, this area hosts major corporate campuses, including Toyota Motor North America and 40 Japanese companies, making it a strategic location for this hotel. The hotel will not only offer luxurious accommodations, but will also include a traditional Japanese restaurant, an upscale lobby bar, a Japanese bakery, a Texas-style rooftop bar, an outdoor pool, and a fitness center. The design and construction are being handled by the Bett Group as the general contractor, Gensler as the design architect, and Looney and Associates for interior design. The hotel's general manager will be Alejandro Vasquez. In attendance at the groundbreaking were notable figures such as Plano Mayor John Munz, Consul General of Japan in Houston Zentaro Naganuma, and Takashi Wakai, President of Kintetsu Group Holdings. Wakai stated, "We chose Plano as the site for our new hotel because the area has experienced remarkable development in recent years. It is home to many companies, including Toyota Motors North America, and the local community, including Plano, has welcomed us warmly." In other significant real estate news, California-based PennyMac, one of the nation's top mortgage lenders and servicers, has signed one of the largest office subleases in Dallas-Fort Worth. This move is expected to bring 1,800 jobs to Carrollton as the firm plans to occupy 150,000 square feet at 5025 Plano Parkway, with plans to expand to 300,000 square feet. PennyMac expects to begin operations in Carrollton by the end of the year. Supported by a grant of up to $1.8 million approved by the Carrollton City Council if certain conditions are met. This expansion reflects PennyMac's commitment to its people and its belief in the future of the industry. Paul Szymanski, PennyMac's Chief Production Operations Officer, stated, "Through this investment in a best-in-class facility and access to the exceptional talent in the Dallas-Fort Worth area, we will drive growth for PennyMac." Additionally, VanTrust Real Estate, LLC, will develop 2 speculative industrial buildings as Phase 1 of its Terrell Logistics Center on a nearly 75-acre site. Construction is expected to begin in the second quarter of 2026 and finish by the second quarter of 2027. Phase 1 will feature a more than 200,000 square foot and a more than 500,000 square foot rear load facility. Phase 2 will include a more than 1 million square foot cross-dock facility actively marketed for build-to-suit during Phase 1's construction. These developments, along with the expansion of Fielding Law's headquarters to Richardson's Tower at Lakeside and the restoration of historic bridges into Turtle Creek Park, signify robust growth and investment in the Dallas-Fort Worth real estate market. Each of these projects reflects a strategic commitment to enhancing infrastructure and providing new opportunities for businesses and residents alike. In Temecula, California, SRS Real Estate Partners has successfully arranged the sale of a single-tenant retail property for $9.8 million. This property is part of the Butterfield Station, a 70,455 square foot grocery-anchored retail center. The retail space in question is occupied by Fitness 19 and spans 30,057 square feet. This transaction marks the completion of Butterfield Station's $26.5 million 4-parcel breakup strategy. The breakup of Butterfield Station saw several significant sales in 2024. A 30,038 square foot Smart and Final grocery store was sold for $11.5 million, while a 5,360 square foot multi-tenant strip center fetched approximately $2.3 million. Additionally, a 5,000 square foot Wells Fargo property was sold for around $2.3 million. Each of these properties was acquired by separate private investors, illustrating a strong interest in the retail sector within this region. This strategic sale of Butterfield Station's parcels reflects a broader trend in the retail real estate market, where investors are keenly pursuing opportunities in grocery-anchored centers. The demand for such properties continues to rise, driven by their stability and consistent foot traffic, which are appealing to investors seeking reliable returns. While this type of retail investment is thriving in Southern California, a similar trend can be observed in the Kitchener-Waterloo area of Ontario, Canada. The region has seen a rise in demand for mixed-use developments that combine retail with residential and office spaces. This trend aligns with the growing interest in creating vibrant, walkable communities that offer convenience and lifestyle benefits. Across the border in the United States, the appeal of grocery-anchored retail properties is mirrored in other urban centers, where investors see value in the stability these properties offer. As retail evolves, these centers continue to be a focal point for both local and international investors looking to capitalize on secure, income-generating assets. In a noteworthy move, Walmart has purchased the Walmart Center Retail Plaza in Norwalk, Connecticut for $44.5 million. This acquisition marks Walmart's transition from just being a tenant to becoming a landlord for multiple businesses within the plaza. The 165,409 square foot plaza is anchored by a 118,630 square foot Walmart, with other tenants including Panera Bread, Qdoba Mexican Restaurant, Ulta Beauty, and Just Salad. This strategic purchase by Walmart is part of a broader trend where large retailers are opting to own rather than lease the spaces they occupy. Retail expert Paco Underhill explains that big box stores like Walmart have historically backed into the role of being landlords due to improved supply chain management practices. By using only 80% of their former space, these stores have been able to sublet areas within their premises. Underhill highlights that this shift allows retailers to have more control over their store environment and the surrounding retail space, including the ability to redevelop properties and manage the mix of tenants within their shopping centers. Charles Brooks, Marketing Department Chair at Quinnipiac University, notes that this shift from leasing to owning is not limited to Walmart. Other large retailers, such as Dillard's and Publix supermarkets, are also purchasing shopping complexes that house their stores. Brooks points out that owning the real estate provides retailers with greater flexibility to adapt spaces to their specific needs and avoid uncertainties related to lease negotiations and potential rent hikes. Brooks also mentions a renewed investor confidence in retail real estate, particularly in well-located grocery-anchored shopping centers. Despite predictions about the demise of brick-and-mortar retail, the sector has shown resilience. Investment in retail properties has increased, especially in centers catering to essential needs and offering a diverse mix of tenants. This reflects a broader trend of stability and growth in the retail real estate market, both in the United States and in regions like Ontario, Canada. Mark Brody from KJZZ reported that vacancy rates for office and retail spaces in the Metro Phoenix area have been declining. According to a new report from commercial real estate firm CBRE, the third quarter of this year saw a decrease in vacancy rates and an increase in rental rates. Senior Vice President Dave Barrett discussed the numbers, highlighting a 5% drop in retail vacancy rates and a nearly $19 increase in rent. This trend is attributed to the influx of 80,000 to 100,000 new residents in the valley, pushing demand for retail spaces, especially in suburban areas. Barrett noted that prior to the COVID-19 pandemic, many retail groups were reducing their footprint due to the rise of e-commerce. However, post-pandemic, there's been a resurgence in community engagement and entrepreneurial ventures, such as coffee shops and restaurants, driving down vacancy rates and pushing rents higher. The West Valley, including areas like Avondale and Goodyear, has seen significant retail growth due to new residential developments and master-planned communities. In terms of office space, the vacancy rate has decreased by almost 22%, with rental rates also on the rise. This change reflects a shift from the initial impact of the pandemic, where office spaces were deemed unnecessary. Now companies are investing in quality spaces to enhance employee experiences, often opting for buildings with shared amenities. The balance between remote work and in-office presence has led to a hybrid model, impacting the types of spaces being developed and occupied. Comparatively, in the Kitchener-Waterloo region of Ontario, Canada, there's also been a noticeable demand for mixed-use developments, combining retail, office, and residential spaces. This mirrors the trend in Phoenix, where developers and investors are focusing on creating vibrant communities that offer both convenience and lifestyle benefits. As vacancy rates decline and rental rates rise on both sides of the border, it's evident that the commercial real estate market is adapting to new consumer and business needs. In Daytona Beach, Florida, a significant new development is on the horizon with the introduction of the Florida Logistics Center. This 276-acre mixed-use project is poised to make a substantial impact on the region's real estate landscape. The project is being spearheaded by Alchemo Capital LLC, and it's designed to cater to the growing demand for logistics and commercial spaces in the area. The Florida Logistics Center is set to feature a blend of industrial, commercial, and retail spaces, strategically positioned to leverage its proximity to major transportation hubs. This development is expected to attract businesses seeking efficient access to both regional and national markets. With its expansive footprint, the project will offer opportunities for tenants across various sectors, including warehousing, distribution, and retail. As the project progresses, it's anticipated to generate significant economic activity in Daytona Beach, creating jobs and stimulating local businesses. The introduction of such a large-scale development highlights the region's potential as a logistics and commercial hub, drawing parallels to similar projects seen in other parts of the United States, such as the developments in the Dallas-Fort Worth area. The Florida Logistics Center's emphasis on mixed-use development aligns with broader trends in commercial real estate, where integrating industrial, retail, and office spaces creates more dynamic and versatile environments. This approach is not only beneficial for businesses, but also enhances the community by providing a diverse range of services and amenities. As we look at cross-border relevance, the concept of mixed-use developments is also gaining traction in Canadian markets, particularly in regions like Kitchener-Waterloo and London, Ontario. These areas are witnessing a similar push towards creating integrated spaces that cater to both business and residential needs, reflecting a shared vision for sustainable and community-focused real estate development. This trend of mixed-use logistics centers is indicative of a broader shift in the commercial real estate landscape, where adaptability and strategic location are key drivers of success. As these projects continue to evolve, they offer valuable insights into the future of commercial real estate, both in North America and beyond. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.